Welcome to this explainer. If you've ever felt totally overwhelmed by the sheer number of equity funds out there, or if you're just trying to figure out where to safely anchor your money in a crazy roller coaster market, you are absolutely in the right place. Today, we're unpacking the strategy behind one of the absolute giants of the Indian mutual fund industry, the HDFC Large Cap Fund.
Here's our quick roadmap for today's explainer. 1. The large cap advantage. 2. Historic performance and volatility. 3. Decoding key risk metrics. 4. Benchmarks and peer comparison. And finally, 5. Long-term wealth planning. Let's dive in. Let's be real for a second. In a market full of extreme volatility, absolutely everyone wants to grow their wealth. But the steep, sudden drops of mid and small caps, those can be terrifying, especially if you're a beginner or just a more conservative investor. So the big question we're answering today is this. Can you effectively compound your capital without constantly checking your portfolio in a total panic?
All right, section 1, the large cap advantage. Before we get into the heavy numbers, we really need to define our terms here. When we say large cap, we aren't just tossing around a financial buzzword. As defined by the regulator, SEBI, large cap funds have to invest heavily in India's top 100 corporate giants by market capitalization. We're talking about massive, established institutions, companies like HDFC Bank, Reliance, Bharti Airtel. These are businesses with rock-solid balance sheets that offer reliable growth and dividends, rather than those short, aggressive, and highly unpredictable bursts you see elsewhere. And to really grasp the sheer scale we're dealing with here, just look at the assets under management. It's currently hovering around 35,458 crores. That is a staggering amount of capital. It makes this scheme one of the absolute bellwethers of the Indian asset management landscape, and it carries an immense responsibility to preserve and grow investor wealth. Now, the internal distribution brilliantly illustrates the fund's stability. While their mandate requires a minimum of 80% in large caps, this fund currently anchors over 86% of its portfolio right there in those top 100 giant and large cap stocks. They do strategically sprinkle in about 13% in mid-caps to capture a little extra growth, sure, but the vast majority of your money is invested in corporate fortresses that are quite literally designed to absorb economic shocks. Moving right along to Section 2, historic performance and volatility. Okay, this is where things get really interesting. Notice the stark contrast in these timelines. Since its inception back in 1996, the fund has delivered an incredible historical return of over 18%. Over a 5-year horizon, it's sitting at a very solid 15.44%. But wait, look at that 1-year return. It's hovering around a sluggish 1.49%. Honestly, if you only looked at the last 12 months, you'd probably be pretty concerned, right? A 1.5% return in a roaring market is definitely enough to make any beginner panic. But listen, context is everything here. This recent sluggishness is largely driven by a temporary drag in the banking sector. The fund has a heavy conviction bet, nearly 35% actually, in financial services. Plus, in these highly aggressive, momentum-driven rallies we've been seeing, the fund manager's focus on high-quality, reasonably priced stocks can temporarily lag behind high-flying, riskier assets. So it's a feature of their disciplined strategy, not necessarily a bug. Which brings us to Section 3, decoding key risk metrics. If you pull up the fund's fact sheet, you are always going to see this SEBI very high risk label. It's a mandatory warning for equity funds because of inherent market risks. Simply put, if the whole stock market drops, large caps are going to drop too. But hey, don't let the bright red dial scare you away. Let's actually look under the hood to see how the fund manages this volatility internally. Let's decode these numbers because they are super important. The standard deviation is 13.65% versus the category average of 14.26%. That means it's noticeably less bumpy than its peers. A beta of 0.96, that means the fund acts as a shock absorber, moving slightly less violently than the broader market index. And honestly, my absolute favorite metric here is the downside capture ratio of 94%. This means if the market falls by 100 points, this fund historically only falls by 94 points. It actively cushions your portfolio during market corrections. How cool is that? And this perfectly highlights the trade-off you make as an investor. While mid and small caps might surge ahead and grab all the flashy headlines during massive bull markets, they completely lack the downside protection we just talked about. Large caps are the ideal core holding for risk-averse investors precisely because they preserve your capital better when the economic weather turns stormy. Okay, Section 4, benchmarks and pure comparison. When we line HDFC up factually against major peers like Nippon, ICICI, and SBI, it holds highly competitive 3-year and 5-year returns, landing firmly in that 15% range. However, as an informed investor, you should definitely note the slightly higher 1.61% expense ratio on their regular plan. If you're investing through an advisor, that's the fee you pay. But if you manage it yourself, opting for the direct plan can save you a pretty significant amount in fees over the long run, which directly boosts your net returns. To build on that context a bit, consider the benchmarks. Sure, the nifty large mid-cap 250 index might outpace this fund during irrational, massive growth cycles. But HDFC reliably outpaces its own primary benchmark, the Nifty 100 Total Return Index, over long horizons. In fact, it's consistently generated positive alpha, which simply means the fund manager's specific stock picks are actively adding real value over just buying a blind index fund. And finally, Section 5, Long-Term Wealth Planning. We have to remember, equity mutual funds are not get-rich-quick schemes. Historical multiplier data clearly shows that holding this fund for a 5 to 10-year horizon is where the real magic happens. A multi-year timeline completely smooths out those scary one-year slumps we saw earlier, turning your patience into compounded capital growth. The longer you hold, the more the underlying company's actual earnings growth dictates your returns, rather than the random daily mood swings of the stock market. As the financial analysts in our sources note, these top 100 blue-chip companies are the absolute best positioned to absorb economic pressures, inflation, and global headwinds. Furthermore, as India marches structurally towards becoming a $5 and eventually a $7 trillion economy, these massive corporate leaders are perfectly poised to be the primary beneficiaries of that national growth story. Understanding these risk and return metrics is your first crucial step to long-term wealth planning. The data clearly tells us that a fund like this serves as an excellent, stabilizing anchor. So I'm going to leave you with this final thought. Take a hard look at your own investments today. Do you have the right, resilient bedrock in place to capture India's growth while weathering the inevitable storms of the years ahead? Thank you so much for joining me on this explainer, and keep learning.